let's say you have that $900,000 property, right? You're going to have to figure out the land value. Now, for the sake of this example here, we're going to assume that 80% of that purchase price is the building and its land improvements. So we're going to go to $720,000. Now, with the cost segregation study, somewhere between 20 and 30% of that will be reallocated to components that are eligible for bonus depreciation. So we'll split the difference. We'll go right down to 25%, and we're going to get 180,000. So that entire amount would be deductible in in the year that that property is placed in service.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Hey folks, welcome back to the show. Today's guest, Tom Castelli, is a tax strategist, real estate investor, podcast host. He's dedicated to helping real estate investors reduce their tax burden and build lasting wealth. Tom has helped countless high-income earners, individual investors, syndicators, fund managers, large-scale operators keep more of their hard-earned money. You can find him on LinkedIn, on Instagram, at Thomas Castelli CPA, or on YouTube, youtube.com/@Thomas Castelli. Tom, thanks for taking the time today.
Thanks for having me. It's an honor to be here today.
Are you in South Florida? Are you in Miami?
Yep, I'm living in Miami. I can look out the window right there and sunny Miami. It's beautiful.
I should have started with that. How long have you been in South Florida?
I moved to South Florida in October 2024.
Okay, so about coming up on 2 years now. How's South Florida been treating you?
I grew up in New York, and I love New York to death. Don't get me wrong. But the weather down here in South Florida, especially during this time of the year, it's January, is certainly better. I was just in New York for Christmas, and it was 18 degrees. Today it's 77 degrees right now. So, I can't complain.
Which part of New York? I grew up in northern New Jersey, a town called Caldwell, West Caldwell.
Yeah, so I was born and raised on Long Island. I lived in Suffolk for most of my life, and then I lived in Nassau County for a bit and Astoria, Queens. So kind of all across Long Island, but Long Island was like my primary place in New York.
Okay, we can probably have relate being part of the tri-state area. I was in northern New Jersey visiting my folks for Thanksgiving, and I was like, I don't miss the cold. I actually live in Santo Domingo, the Dominican Republic. So like you, I enjoy the warm weather. I do want to dive in and talk about tax strategy, tax savings, and some of the niche areas where people can really hold more of their money, right? Retain more of their money when it comes to real estate investing. One of the things that's interesting right now, and I was watching one of the videos that you had on your channel, is cost seg, right? And with the big, beautiful bill, 100% bonus depreciation, who can take advantage of that?
Right. So pretty much all real estate investors who are, buying rental properties, so buy and hold properties, you're holding them for rent for the long term, can take advantage of bonus depreciation. The question is, how impactful will it be? For some investors, it will be more impactful than others. So I'm happy to go through what it looks like, give the whole rundown. Just let me know if you want me to do that.
Yeah, let's start here. I mean, when we talk about 100% bonus depreciation, some misnomers, right? You've
Yeah.
got to build the property yourself, right? It's
Yeah.
got to be built in the last couple of years, right? Or hey, if it's at the end of its depreciable life, uh, is it is there a situation where if you're buying a property, you wouldn't want to take advantage of it?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Yeah. So, I mean, in situations you probably would not want to take advantage of 100% bonus depreciation would be a property you intend to flip. If you intend to flip a property, it's usually considered inventory and not an asset for tax purposes. So you wouldn't be able to actually depreciate the asset at all. So you probably wouldn't do a cost segregation study on it, and you wouldn't be eligible for 100% bonus depreciation. The only other time that like really sticks out as like a probably not is if you only intend to hold the property, even though you might be renting it out, not flipping it for a very short period of time.
Hmm.
Because oftentimes you might take the bonus depreciation, and then if you sell it, you could be subject to depreciation recapture. And there are ways to mitigate that via 1031 exchanges or other strategies, other exit strategies. But that's kind of the only times that I'm really kind of that's coming to top of my head right now that you would want to not do it. Um,
Very basic question, and forgive me for not knowing the answer to this, but when we talk about 100% bonus depreciation, it's 100% of the purchase price. What is the 100%
yeah.
referring to?
Yeah, great question. So let me break this down high level, right? So when you buy a property, you're usually going to have the building and the land improvements. So the building itself is the actual structure of the house, whatever have you, and then like land improvements are things like landscaping, pools, decks, sheds, things of that nature. Those items are depreciable. The land itself is not depreciable. So there's always a part of the purchase price that's dedicated to land, even if in condos, believe it or not. We don't have to go down that rabbit hole. But the components that are eligible for 100% bonus depreciation are the components that have a 5, 7, and 15-year class life because uh, bonus depreciation applies to assets that have a class life of less than 20 years. So when you buy a single family residence, for example, a single family home, that is depreciated over 27 and a half years. That's kind of the default treatment. So you're gonna take that in just a little bit over 27 and a half years, you can get a little depreciation expense every year. However, what happens is when you have a cost segregation study performed on your property, an engineer is going to break down the components and say, okay, here's the components of your property that are truly 27 and a half year class life, which is probably somewhere around 70, could be anywhere between, let's call it 60 to 70% of the property, right? Whereas here's the components that are 5, 7, and 15-year property, which usually makes up somewhere between 20 and 30% of the assets of the building's value. So maybe I got the other percentage wrong, but it's 20 to 30% are usually reallocated to this other to the components that are eligible for bonus depreciation. Um, and 5-year property is considered tangible personal property within the, so think of things like uh, appliances, fixtures, carpeting, things of that nature, as a whole bunch more, but things of that nature. And then the land improvements, that's the 15-year property. That is the pools, deck sheds, things like that.
Now, I know this is going to be a tough question. So this is there's of course no one size fits all. But if you're looking at where I'm from in northern New Jersey, and you're looking at a very middle class home that might be $900,000, and let's say the home is, I don't know, 10 years old, what's the range of deductions that someone might be able to take through a 100% bonus appreciation?
Yeah. So in certain states, certain areas, land value can be higher than other states. So northern New Jersey, for example, I'm sure land value is a significant component of it. So I'll just use a national example just to keep things things a little bit more straightforward. So let's say you have that $900,000 property, right? you're going to have to figure out the land value. Now, the land value you can figure out through the property tax card or through an independent third party appraisal on what the land value is. But for the sake of this example here, we're going to assume that 80% of that purchase price is the building and its land improvements. In other words, the parts that can be depreciated. So we're going to go ahead and take 80% at 900,000, we'll get to $720,000. So that's the part that's depreciable. Now, with the cost segregation study, somewhere between 20 and 30% of that 720 will be reallocated to components that are eligible for bonus depreciation. So we'll split the difference. I know we should never do that, but we're going to do it anyway. We'll go right down to 25%, and we're going to get 180,000. So that would be $180,000 would be the amount that's eligible for bonus depreciation. And right now, bonus depreciation is at 100%. That is made permanent under the recent One Big Beautiful Bill that was signed in July 2025. So that entire amount in this example, $180,000, would be deductible in in the year that that property is placed in service.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Cost segregation studies are going to vary, right? So you're going to have size, you're going to have complexity. Is there a national average for what a cost seg is on a single family home?
So yeah, it definitely varies depending on the study. Probably for single family home, somewhere between $2,000 to $3,000. Typically, it could be more depending on the cost segregation firm, the location of the property, this so on and so forth. But I'd say somewhere between $2,000 to $3,000 is an appropriate would be an appropriate estimate.
So before the big beautiful bill, were people doing cost seg for like single family homes, or is this something that's new to the single family space?
Yeah, so it's definitely not new. I'd say so. Back in 2017, the Tax Cuts and Jobs Act introduced 100% bonus depreciation initially, and it made 100% put 100% bonus depreciation in play from 2017 all the way through 2022, when it began to phase out in 2023 before it was brought back in 2025. So we've seen a lot of people pick up ever since 2017 and that bill was passed. That's when you've seen cost segregation start to make sense on single family homes. Before that, it was mainly commercial properties just because
Right.
the expense relative, because there was no 100% bonus depreciation. So you were getting enhanced depreciation benefits because you were able to depreciate the 5-year property over 5 years instead of 27.5 years, and the 15-year property over 15 years instead of 27.5. So it was still accelerating depreciation, so giving you increased deductions, but the cost benefit wasn't there on your typical single family property. Maybe on a large commercial property where the numbers are much larger, there was a cost benefit. But really, since 2017, I'd say that's when at least I started seeing it, make sense on single family, and a lot of people started taking action on that.
Another kind of granular question here. I speak with a lot of mobile home park investors. I know that's not considered real property. Could you do some type of cost seg on a mobile home? Do you know?
Yeah, absolutely. So mobile homes, there's a few different kind. I can get into some of the nuances here, but long story short, a large component, a large part of what you're purchasing with a mobile home is land improvements. So land improvements is that 15-year property. So it's not uncommon to see somewhere around 70% or perhaps even more in some cases of that purchase price being eligible for bonus depreciation when it comes to mobile home parks. Go a step further, depending on whether you have park owned homes and depending on what type of park owned homes those are, you might even be eligible for even more depreciation. Specifically, if you have like mobile homes that are movable, that are not permanently affixed to the ground, um, those are considered 5-year property, which is also eligible for bonus depreciation. So, depending on the type of homes you have in the mobile home park, if you own them as the owner, you might be for enhanced benefits. But typically, if you're just looking at you're renting pads, and that's just what you're doing at a mobile home park, you're looking at probably around 70% or more in bonus depreciation on the purchase price.
What's interesting about mobile homes is they're not making any more mobile home parks, from what I understand. I've spoken with a number of investors who invest in this space, and very very rarely have I heard the conversation, yeah, we're building a mobile home park. And I think there's a lot of reasons for that. One of the main ones is that I don't know necessarily that they're a huge driver of tax revenue for the areas that they're being placed in. And so people are looking at other asset classes versus mobile homes. For investors who are looking at, outside of single family investing or small multifamily investing, and they may be looking at storage facilities, mobile home parks, RV parks, or like ADUs, right? Are there any specific tax strategies or benefits that would go along with any of those different segments of the real estate space?
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Yeah. So yeah, that's it's pretty wide. I would say that that's tough. Yeah, I would say if you want to look at strategies in that space, you want to look at the real estate professional status. If you're going to be investing in long-term rentals, mobile home parks, things like that. If you're investing in, you could also look at short-term rentals. There's some unique benefits that come, tax benefits that come with investing in short-term rentals, and most short-term rentals are typically single-family homes or condos or what have you, but not always. So those two strategies, and I'm happy to unpack some of those, unlock significant tax benefits, really across those asset classes.
I was unaware that there's tax benefits for short-term rentals for STRs. What type of things can people take advantage of with STRs?
Yeah, yeah. So this definitely ties in with bonus depreciation. So under the tax code, all rental activities or rental properties are passive by default. So what does that mean? That means that the losses that are passed through to you, typically through depreciation deductions, um, cannot offset your active income. Active income being like W-2 income or income from a business that you're running. There's an exception for that called the real estate professional status, which allows you to take those losses against your W-2, your active business income. However, to qualify as a real estate professional, you need to spend more than 750 hours and more than 50% of your total working time in real estate. So, in other words, you need to be working full time in real estate. It's going to be very challenging for people who have a full time job or running a full time business to do. With short term rentals, if you have an average period of customer use, that's the official language, or just an average guest stay, you could look at it as of 7 days or less, then it's not considered a rental activity. It's considered a business. And with a business, you do not need to spend more than 50% of your total working time. You just need to meet one of seven material participation tests, which can allow you to spend as little as just over 100 hours on your short-term rental property and take the losses as non-passive against your W-2 or active business income. And for a lot of high income earners, a lot of couples who are working full time, that is a very lucrative strategy for them.
For folks who have a W-2 and they may be looking at getting into real estate, and I would put myself into this category before I went full time with it, right? You're not aware that there may be some tax savings that you could recoup against your W-2 income. I want to use the example of someone who may be starting out in wholesale or as a realtor, but they aren't necessarily making lots of money in wholesale or as a realtor. Would they be able potentially to do things like deduct mileage if they're tracking mileage for driving between appointments and that type of thing
Yeah.
against W-2 income?
Yeah, yeah, absolutely, absolutely. So especially as like if you're a if you're a real estate agent, or you're running another real estate business, you are yeah, that's not a rental activity. So as long as you're actively involved, which most of the time you are as a real estate agent, in fact, almost all the time you are, um, uh, yes, you can deduct things like mileage, home offices, things like that against your W-2 or your active business income.
Yeah, I think there's a ton of people, and I was just having this conversation yesterday with an enrolled agent. There's a ton of people who don't think about tax strategy until they've got a tax bill to pay.
Right.
But, I look back at all of the W-2 taxes that I paid while I was also running, an unincorporated business, a side hustle, just trying to make some extra money, realizing I was putting in miles. I was buying office supplies. I would have put money into advertising, right? Put extra miles on my car. And we don't think about, hey, this is a way for me to actually recoup some of the taxes that I've already paid in through my W-2.
Right, right. Yeah, there's a lot. So if you have a side hustle, that is all active income or losses for the most part. So if you have a loss from your side hustle, you can often take it against your other forms of income, like your W-2 income. You just have to be careful for the hobby loss rules. The hobby loss rules, long story short, says that if you're operating a business at a loss for 3 years in a row, the IRS could come back and say, hey, are you really operating this for profit, or is this just like a shell company or something like that? And they could turn into a hobby. And if it becomes a hobby, you can't deduct the losses. So but long story short, in most side hustles, if you have a loss, you're going to be able to offset it against your W-2 income.
Are there any common mistakes that you see newer investors making, that you think could be relatively simply remedied when it comes to either tax strategy or setting up their businesses or so on?
Yeah. So mistakes, yeah, mistakes. There's an incredible amount of mistakes. I could go on for forever on this, but the one biggest mistake, and this is going to be, it's going to sound maybe boring, is not keeping good books and records. I mean, bookkeeping at the end of the day, because a lot of your business is whether you want to make better financial decisions to grow your business, or are you overspending in areas, or hey, what is your tax liability currently? Can we estimate that for you? And how can we actually make moves to lower it in a strategic way, a more targeted way? It all starts with the foundation of the bookkeeping. So a lot of investors overlook that or neglect it. And I think that's just the biggest mistake. I know it's not the most sexy mistake to talk about, but it is certainly a foundational mistake that a lot of investors make.
Hey, I would throw myself in that category. I hired someone to help with tax strategy myself at the tail end of last year, and I was thinking, yeah, I can keep my books. It's not that complicated. I know I'm a one man show, and so when I'm diving into it with my enrolled agent, I'm realizing, oh my gosh, this is so complicated. I'm glad I'm starting this now and not years down the line. For folks who are coming to you and they're doing their own books, of course that can be chaotic. Is there some of it like you have to go and forensically identify what's happened in the previous years, or can you start now if you potentially were doing your books improperly over the years?
Yeah, so that's a great question, and it definitely depends. If it depends, like unless you need it for like lenders or some like historical records for lenders, or you haven't filed your tax returns. Most of the time, it's like for prior years. You haven't filed tax returns in prior years. You could just probably start fresh this year. We're recording this in January, for example. Like depending on what you need the financials for, sometimes it's just good just to start over, and just start clean. So to answer your question, it depends, but in most cases, it's unless you need it for those purposes, you're probably good just to get started, from scratch, from where you are today.
Tom, we are coming up on time here. Any new projects that you're working on, or where can folks go to reach out to you or your team?
Yeah, I think the best way to reach out. We do have a podcast, the Tax Smart REI podcast, out on Apple, Spotify, wherever else you can find podcasts. It's we do talks on tax strategies all the time. We have a great backlog of content there you could check out. Otherwise, you can get in touch with me. The best way to get in touch with me, just going to my personal website or finding me on LinkedIn. It's thomascastelli.com. I just have all my links and stuff there. It's basically just like a resume type of website. But that's just the best way you can get in contact with me is that way.
Tom, thank you so much for your time today. Thanks for coming on the show.
Thanks for having me, Dylan.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.